In this market, everyone is obsessed with the flash. The AI revolution, the tech giants, the companies that make headlines every single hour. It's easy to get caught up in that noise. But sometimes the most lucrative opportunities are sitting right there in the boring section of the market, screaming to be noticed, if you just know how to listen.
That's exactly right. It's the difference between chasing a firework and planting an oak tree that grows money. The market has this fascinating inefficiency where it gets distracted by the shiny objects and completely ignores high-quality compounders that are printing cash. And today we are looking at a prime example of that.
We are talking about Raymond James Financial, ticker symbol RJF. Now, before anyone tunes out thinking, oh, financial services, how exciting, let me stop you. We aren't just looking at a bank statement here. We are looking at a setup that combines deep fundamental value with a technical coiled spring.
It's a classic sleeping giant scenario. We have a company that is fundamentally outperforming its peers, yet the market sentiment is surprisingly neutral. That gap between how good the business actually is and how the market is currently rating it is where the profit lives.
So, let's start with the big picture. Why is this on our radar right now? What is the headline that triggered this deep dive?
The headline is confidence, specifically $2 billion worth of confidence. Raymond James just announced a massive $2 billion share repurchase plan and an 8% dividend hike slated for December 2025.
$2 billion is not a small number.
It's huge. When a management team authorizes a buyback of that magnitude, they are sending a very specific signal. They are effectively saying, we know our business better than anyone else. We see where our stock price is trading, and we think it is too cheap. They are betting on themselves. It creates a fundamental floor for the stock price because you have a guaranteed buyer, the company itself, stepping in to support the value.
It's the ultimate insider vote of confidence. But let's look under the hood. A buyback is great, but it only matters if the engine of the car is actually working. Is Raymond James actually making money efficiently?
This is where the numbers get really impressive. The metric we need to focus on here is ROE, return on equity. For those listening who might not track this daily, ROE is basically a measure of how good management is at using your money to generate profit.
Right, if I give you $1, how many cents of profit do you give me back?
Exactly. And Raymond James is posting an ROE of 17.47%. In the financial sector, that is exceptional. It shows high-level efficiency. They aren't just burning cash to grow, they are growing profitably. Their net profit margin is sitting at around 13.56%, which is very healthy.
So they are efficient, and they are profitable. But usually, when you find a company this good, you have to pay a premium for it. You pay up for quality. Is that the case here?
That's the kicker. You don't. The stock is trading at a price-to-earnings ratio, or PE, of about 15.63x.
15 times earnings? That seems incredibly reasonable.
It's more than reasonable. It's cheap for a company of this quality. If you look at the broader market or even high-growth tech, you're paying 30, 40, 50 times earnings. Here you're getting a company growing its revenue and earnings at a compounded rate of nearly 50% over 3 years, and you're picking it up for roughly 15 times earnings.
That feels like a disconnect. Why is it so cheap? Is there something wrong with it?
It's not that there's something wrong. It's that the street, the analysts, are lagging behind reality. The consensus rating right now is a hold. They are worried that growth might moderate, or they are just waiting for a catalyst. But our analysis suggests they are missing the forest for the trees.
They are looking in the rearview mirror while the data is pointing forward.
Precisely. We ran a DCF, discounted cash flow, analysis, which strips away the sentiment and just looks at the raw cash the business will generate. That model suggests the fair value of this stock is actually around $207.50.
Wait, let me do the math. The stock is trading around $167 today. You're saying the intrinsic value is $217.
That's right. That implies an upside potential of nearly 30%. So you have a 30% upside gap protected by a $2 billion buyback, supported by a 17% ROE. That is the definition of an asymmetric bet. The potential reward far outweighs the risk.
That's the fundamental argument, and it's compelling. It's the value investor dream. But we know that value traps exist. Stocks that are cheap and stay cheap forever. We need to know if the stock is actually moving. What does the technical picture look like?
This is where it gets exciting for the traders listening. We aren't just looking at a value play that might pay off in 5 years. We are looking at a swing trade setup that is actionable right now.
Walk us through the chart. What are you seeing?
The stock is in a clear confirmed uptrend. It is trading above all its major moving averages, the 50-day, the 200-day. That tells us the long-term momentum is bullish. The wind is at our backs. Recently, the stock hit a high of roughly $177 and has pulled back slightly to consolidate.
And consolidation is healthy, right? We don't want a stock that just goes straight up until it explodes.
Exactly. Think of it like a runner taking a breath before the next sprint. The stock pulled back to around the $167 level. This is a crucial support zone. It's testing the buyer's resolve. And what we are seeing is that the structure is holding. The 4-hour chart shows momentum is neutralizing, which usually happens right before the next leg up.
So we have a buy the dip scenario in a strong uptrend.
Yes. The technical score we've assigned is 75 out of 100. The only reason it isn't higher is because we are relatively close to that 52-week high, so we need a breakout to really unlock the sky. But the setup here is a classic swing trade. You enter on the pullback, ride the momentum back to the highs, and potentially break through.
I want to circle back to something you mentioned earlier about the analyst consensus. You said they are at a hold. Doesn't that worry you? If the big banks are saying hold, why should we be buying?
It's actually a contrarian signal. When everyone is already shouting buy, the good news is usually priced in. There's no one left to convert. But when the consensus is hold, despite fantastic fundamentals, it means there is a reservoir of potential upgrades waiting in the wings.
Ah, I see. So if Raymond James crushes their next earnings report, which is expected around January 28th, those analysts will be forced to upgrade their ratings.
Exactly. And when they upgrade, that brings in institutional buying, which drives the price up. We are trying to get in before the upgrades. We are positioning ourselves ahead of the crowd.
It's about anticipation versus reaction.
The catalyst landscape is strong too. Aside from the buyback, M&A activity, mergers and acquisitions is heating up globally. RJF benefits directly from that through their investment banking arm. Plus, they just secured a nearly $700 million program with Bank Midwest. They're growing organically and through deal making.
So we have 3 pillars here. 1. Fundamentals are rock solid with high efficiency and undervaluation. 2. Technicals show a strong uptrend with a perfect pullback entry. 3. Sentiment is lagging, providing a catch-up opportunity.
That's the trifecta. And frankly, it's rare to find all 3 aligned this cleanly. Usually, you get great fundamentals, but a broken chart, or a great chart on a terrible company. Here, the stars are aligning.
Let's talk about risks. We have to be responsible here. What could go wrong?
The biggest risk is the macro environment. RJF is a financial stock. If interest rates shift violently, or if we hit a recession, their assets under management drop and their fees drop. Also, we have that earnings report coming up in late January. Earnings are always a coin flip volatility event.
So if we are trading this, we need to be mindful of that date.
Correct. If you are a swing trader, you probably want to be out or significantly trim your position before January 28th to avoid that event risk. If you are the long-term investor, you ride through it because the dividend and buyback protect you.
That brings up a philosophical point about the market right now. We are seeing this bifurcation where you have the haves and the have-nots. RJF seems to be a have that is disguised as a have-not.
It's an inefficiency of attention. In a world of algorithmic trading and hype cycles, steady compounders get boring. But boring is beautiful when it compounds at 15% a year. The market is offering us $1 for 75 cents here. The question is, Do you have the patience to pick it up?
It really challenges the idea that markets are perfectly efficient. If they were, this gap between price and value wouldn't exist.
Markets are efficient eventually, but they are incredibly inefficient in the short term. That's the trader's edge. We are exploiting the time lag between reality and perception.
Okay, let's land this plane. We've laid out the case, it's compelling. But our listeners need to know exactly what to do with this information. We need a battle plan.
Right? We are going to structure this specifically for the swing trade opportunity we discussed, because that is where the immediate edge lies.
Let's break it down, step by step.
Okay, get your pens ready. We are looking at a swing trade on Raymond James Financial, RJF.
First question, when do we start investing?
You are looking to enter the market immediately. The current price action represents a pullback within a bull trend. The ideal entry point is right here at the current market price.
Okay, give us the specific number. What price point are we targeting for entry?
We are buying at approximately $167.70. If you can get it slightly lower on intraday volatility, great. But the $167 zone is your structural entry. We are buying the dip against the 50-day moving average support.
Got it. Entry at $167.71. Now, risk management. This is the most important part. When do we leave the market if we are wrong?
We need a tight stop loss to protect our capital. If the structural thesis breaks, we get out. You need to set your stop loss at $163.50.
Why that number specifically?
That level is below the daily 20-period moving average and below the recent structural support. If it closes below $163.50, the uptrend is invalidated, and we don't want to be holding the bag. That keeps your risk to roughly 2.5%.
Okay, so we are risking 2.5%. Now for the fun part. When do we leave the market to take our profit?
We have two targets. Your first target is the swing target at the recent all-time high. You want to sell at $107.66. That's where you take your swing profit.
That's a solid trade. But what about the listeners who want to hold for the big valuation gap?
If you are playing the long game based on the DCF valuation, your ultimate target is $207.50. But for this specific swing setup, take your profits at $177.66, especially before the earnings call on January 28th.
Clear, concise, and actionable. $167.71 to get in. Stop at $163.50. Target $177.66. The $2 billion signal is flashing. It's up to you to decide if you're going to take it.
The data is there, the rest is execution.
Thanks for tuning in. Do your research, stay disciplined, and we'll see you in the market.